Hello, everyone. Today, I will be taking you through one of the biggest financial scandals in India, the National Spot Exchange Limited scam, which shook the confidence of thousands of investors and exposed deep flaws in regulatory oversight. This case isn't just about money. It's about trust, systemic loopholes, and the long road to justice. NSEL, or National Spot Exchange Limited, was launched as India's first electronic spot commodity exchange. It was a joint venture between Financial Technologies India Limited, founded by Jignesh Shah, and the National Agricultural Cooperative Marketing Federation. Now, let us Cooperative Marketing Federation. Now, let us look at the key players involved in the NSEL scam. Jignesh Shah, the promoter of NSEL and founder of FTL, was seen as the visionary behind India's commodity markets. He later distanced himself from direct operational responsibility, claiming he had no role in day-to-day decisions. Anjani Sinha, the CEO of NSEL, admitted to certain lapses but shifted much of the blame onto brokers and borrowers. The brokers played a questionable role, as they missold contracts to investors, often giving false assurances that the returns were safe and guaranteed. On the other side, the borrowers, who were supposed to back these contracts with commodities, defaulted and in many cases siphoned off funds. Lastly, the regulators, first the FMC and later SEBI, were heavily criticized for intervening too late, allowing the fraud to grow unchecked before it finally collapsed. The central figure behind the scam was Jignesh Shah, the founder of FDEL and former CEO of MCX, the multi-commodity exchange. He was also the vice chairman of NSEL at the time of the fraud. Shah, along with his associates, was later arrested for his alleged involvement in designing and benefiting from the scam. The exchange was promoted as a transparent platform that could connect farmers, traders, and investors to trade commodities like sugar, steel, and bullion. On paper, it was supposed to revolutionize commodity trading. In reality, it became the center of a 5,600 crore fraud. The scam unfolded through what were called paired contracts. NSEL sold investors short-term and long-term contracts that were supposed to be backed by real commodities. But here's the catch. Most of those commodities did not exist. When NSEL defaulted on payments in July 2013, over 5,600 crore vanished, impacting more than 13,000 investors, including big institutions like MMTC and PC. It was a financial earthquake. Following the collapse, top executives including Jignesh Shah and Amit Mukherjee were arrested. Investigations by the Economic Offenses Wing revealed forged documents and serious lapses in governance. Meanwhile, FTL's share price crashed by over 60%, wiping out huge market value. Even MCX, once considered prestigious, saw a sharp decline. Shah eventually resigned from its board. For investors, the road to recovery has been long and painful. Legal battles dragged on for more than a decade, involving multiple agencies like the Economic Offenses Wing and the Enforcement Directorate. Brokers were pulled into SEBI settlement schemes, but litigation at the National Company Law Tribunal continues. The delay highlighted the frustratingly slow pace of justice in large-scale financial frauds. In 2023, a breakthrough came with the proposal of a 3,000 crore one-time settlement for affected investors. This was backed by 63 Moons Technologies, NSEL's parent company, and supported by investor forums. The hope is that this settlement will finally bring closure to thousands of people who have waited for justice for over 10 years. What can we learn from this? First, regulatory vigilance is key. Delays in FMC's action made the crisis worse. Second, investors must beware of schemes that look too good to be true. High, risk-free returns often hide dangerous realities. Third, transparency and verification of commodities is critical. Finally, the NSEL scam led to stronger commodity market regulations and better investor protection mechanisms in India. To conclude, the NSEL scam was not just a financial scandal, but a warning bell for India's markets. It showed us the importance of strong regulations, transparency, and investor awareness. While settlement efforts are finally giving investors hope, the bigger lesson is clear. Vigilance, transparency, and robust regulation are the only ways to protect markets and restore trust. The central
Mr. Jignesh Shah, promoter of NSL, how do you explain this?
I built NSEL as a transparent exchange. I was not handling daily operations. If there were lapses, they were management failures, not fraud I created.
Sinha, you were CEO. What went wrong?
Yes, lapses happen, Borrowers defaulted, brokers missold contracts, and my team failed to verify stocks. It was a system-wide breakdown.
Even today, investors will get back only Rs 1,950 crore, just 35% of dues. The lesson? In finance, never trust assured returns without real backing. Verification and governance are the only safeguards against scams.